Bitcoin, I mean, if I look at everything since October 10th, because that was the biggest liquidation in the history of crypto, like bigger than FTX.
Like a margin call.
Yeah, it was like almost a miniature rupture, like a tsunami. We're only a couple weeks from that, so I think the market is consolidating. But if I look at fundamentals, like Ethereum, stablecoin volumes have been exploding, application revenues at all-time highs. So right now, fundamentals are leading price in crypto. So I think eventually we consolidate and then we rally into year end.
One of Lee's biggest insights is how bearish sentiment remains, even as markets climb. He cites data showing that average investor sentiment in 2024 has been net negative, minus 11.5. Historically, this level of pessimism has only appeared 3 times in 35 years, all during bear markets. So even though the S&P is up nearly 17% this year, many investors still feel like it's a bear market. That disconnect, Lee argues, sets the stage for what he calls a performance chase, where underperforming fund managers rush to catch up before year-end. More than 80% of professional fund managers are lagging their benchmarks, meaning they'll be forced to rotate into risk assets and chase returns as markets rise. In other words, the wall of worry becomes rocket fuel for the next move higher.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Do you ever have any trepidation, second thoughts? Do you ever get nervous about any of your calls?
Yeah, all the time, filled with doubts because, the future.
No one can be right off your 51%. You're like the best ever in this business. You're still bullish, even though you talked about last week, a little wobble in some stocks. Sell on the news because of China. Now, it looks like a little bit of hawkishness out of Jay Powell. I don't know if that lasts.
Yeah, that's right. I think the market has a lot of walls of worry because we've got the shutdown, we've got China, we got the Fed speak, but the market's been up 6 months in a row now. Only 6 times since 1928 that's happened. So if you look at November, we're up 5 or 6 times. And in 1942, it was flat. So basically, November should be really strong. I think at least 200 points on the S&P. So maybe...
For November?
Yeah, maybe even 250. So maybe we get to 71.
See, that's a call that I just wish you wouldn't make a call like that, right?
Well, you could 250 to 3% if that makes you feel better.
It does make me feel a little bit better because 250 points to say in November, 250 points. You're giving a time and a size.
But maybe we wobble the first couple weeks just to digest all the gains.
Yeah, that's what I saw in your notes. So initially there could be some choppy trading at this point. What's driving everything? There's still, I guess, sentiment is not positive, is it? You mentioned the wall of worry.
Yeah, I mean, if you look at it like AAII, the average sentiment this year is still minus 11.5, like net solidly bearish. That's only happened 3 other times in 35 years, all in the middle of bear markets. So investors feel like it's a bear market, but we're up 17%, which kind of tells me I think there's a big performance chase into year end. Over 80% of fund managers are missing their benchmark this year.
Wow. And you don't care about not having government data because does the market ever really wait for government data? Or it sort of sniffs it out, doesn't it?
Yeah.
The all-knowing market.
That's right, because we have good Fed futures to look at what's implied for inflation. The Fed looks at the bond market. The bond market figures things out before the data comes out. I do think the inflation is probably falling a lot faster than everyone expects. I mean, you can look at true-flation, and we're down to sub 2% inflation, excluding housing.
Shelter,
Yeah, and shelter is finally cracked.
Yeah. Because that CPI number was, it was just barely cooler than expected, wasn't it?
Yes, but the shelter piece is now at 0.16 month over month. That's at 2% year over year. That level would bring core inflation down sharply. And over 54% of the CPI components are now deflating. It's the highest percentage since COVID started.
It seems, Tom, that the markets have, largely because of what you're describing, moved on from the inflation watch.
Yeah.
They've kind of put that aside as maybe the forefront risk. and much like the Fed has been dragged to doing, wondering about downside risk to growth. I mean, if you just look at things like the reaction of home builder stocks, consumer cyclicals, regional banks, just to that hawkish cut by Powell last week, it seems like it's not hard to get the market a little bit uneasy about, just exactly what kind of a soft patch this is, even if we have confidence that maybe it firms up into next year. So how does that play into the overall action in the index and what you expect from the market?
Yeah, I think there is something the market's trying to figure out, which is AI is consuming jobs, but that's turning it into profits for corporates. So like profits are expanding. And then we have profit margins have actually been going up in the middle of tariffs. So how are companies able to take 70% of the tariff hit, but margins are going up? So there must be a productivity boom somewhere. And then we have, like you said, $7 trillion of cash on the sidelines, but we have high rates. And so the Fed, I kind of think, is trying to not overheat the economy, but we know that you just point out, like, housing's in big trouble. So I would say it makes sense if inflation's in a good place and jobs aren't really strengthening for cuts to happen, and that would be really dovish. So I think that sort of comes together before the end of the year.
Andrew.
Hey, Tom. Have you been reading all these stories that just been out, recently here about how the Fed is doing all of this sort of repo activity, like a lot of repo activity, and I just wonder what that really means for both the markets and maybe even for crypto. This is a ton of money. I mean, it looks like something like $30 billion just to ease liquidity concerns. This is, past couple of days kind of thing.
It is pretty typical into month end, right? That's what we are seeing. And I think that some of these numbers are also being distorted because of the government shutdown. So we know that the Treasury reserves are building because there aren't any payments being made. So it is something we're watching. But if I was to say that there's signs of bank stress, I'd also be looking for high yield spreads to be widening. And those are actually staying pretty calm.
So you figure no problem with 7,000 by the end of the year, more likely something even above that in your view? Like what? Like 7,300?
Yeah, I mean, maybe 7,300, 7,500.
7,500.
Yeah, so we still, in December, we would build on those November gains.
See, Santoli's like, no way.
No, I don't say no way. I'm open-minded to how far bull markets can go, right? Strong years end strong. We all know about that. The one piece of it I think it's worth kind of struggling with a little bit, though, Tom, is you can look at the AAI surveys, kind of what people are saying, and then you see, equity exposures in, Bank of America private client accounts are basically at their highs, right? So people have kind of, in aggregate, been riding this to some degree. And then you see a lot of what we've talked about in the last several months of, this kind of upwelling of speculative action in non-profitable tech stocks, low-quality equities leading. That's not the Mag 7. That's like a lot of other marginal stuff. So how do you jibe that with that sense that people are still skeptical?
Yeah, I mean, one, we know there must be skepticism because if people were bullish, the institutional fund managers should have better performance. But as you know, this is one of the worst years for fund managers in almost 30 years. I think that there is also kind of problems in private markets. So I think private credit is doing terribly, and I think a lot of LPs in alternative funds, whether it's venture or private equity, are pretty disappointed by the returns, like the 5 years into now. But the stock market's done well. So I think that there is bearishness because like private equity hasn't come through and fund managers are doing badly. But you're right, the ones who stuck with public stocks are doing well.
I want you to quit while you're ahead, but I have to ask you about Bitcoin. I mean, you want to go out on a limb there too? Because it's weak again today, 107. Go below 100 or no?
Well, Bitcoin, I mean, if I look at everything since October 10th, because that was the biggest liquidation in the history of crypto, like bigger than FTX.
Like a margin call almost.
Yeah, it was like almost a miniature rupture, like a tsunami. We're only a couple weeks from that, so I think the market is consolidating. But if I look at fundamentals, like Ethereum, stablecoin volumes have been exploding, application revenues at all-time highs. So right now, fundamentals are leading price in crypto. So I think eventually we consolidate and then we rally into year end.
That would represent an additional 10% plus rally from current levels, a powerful continuation of the 2024 bull trend. Skeptics argue that equity exposure in private client portfolios is already high, But Lee counters that institutional underperformance and private market weakness still leave plenty of room for rotation into public equities. In his view, this is a market where bearish psychology lags bullish reality. No Tom Lee interview would be complete without touching on Bitcoin. Despite recent weakness, with BTC hovering near $37,000 to $40,000, Lee remains fundamentally bullish. He notes that since the October 10th crypto liquidation, which he calls the biggest in the history of digital assets, the market has been consolidating but not breaking down.
It's hard to believe that we're now on part 64 of this series. And in fact, we've actually done a few more than that, because beforehand I just called it something else before calling it Bitcoin to be mathematics. But here we are, more than 5 years into this series. And after all this time, starting it way back over here, we're still not that far removed from what you would ultimately consider the quote-unquote fair value to be. Now, as of November 2025, total crypto market cap's coming in at around 3.682 trillion, where the fair value logarithmic regression trend line is coming in around 4.6 trillion. One of the interesting things is that this entire monstrous bull market that Bitcoin's been in for a long time is, we have these periods of undervaluation and overvaluation, and this cycle has been mostly just kind of riding that fair value line. And you could argue that the fair value line is essentially when Bitcoin is stealing the show. When we're kind of at the fair value when Bitcoin is taking more of that liquidity. And when the frothier stuff comes up, that's when you see these cycles where they go more overvalued. But we haven't really seen that this cycle. And, you could base it on any number of things. You could base it on monetary policy, obviously quantitative tightening and high interest rates, although QT is coming to an end in about a month. You could base it on inflation. You could base it on people just getting tired of getting rug pulled on various meme coins, and so they just stick to Bitcoin. I don't really care what you base it on, but at the end of the day, this entire asset class has been essentially right at the fair value for the last several years. In May of 2022, you can see that the total market cap of crypto was right around a little less than 1 trillion, which is right around where that fair value was. And today, again, the fair value is around 4.6, and we're about 3.6 or so. It's not going to be a perfect fit, obviously, but it does go to show that it has worked out pretty well. And really, this is more evidence of how similar it's been to that 2019 phase, where you had a bull market, but it really never went more durably overvalued. It was just sort of going just above the fair value and then coming right back down. Just that this cycle we did it a couple of times, maybe even almost three times of seeing that play out. If you actually take the percent difference between the total cryptocurrency market cap and the fair value logarithmic regression trend line, you get a chart that looks like this. And you can see that red line, that's what represents the fair value. And you can see that every time we get above it, it just sells off. And we've seen that in prior cycles, right? It's not like we haven't seen that before. It's just that typically at some point it would go more overvalued. And we just haven't really seen that, right? We haven't really seen that yet. Now, who knows? There's still theoretically time. I would argue, though, that the time is running out for this cycle. If you do believe in the 4-year cycle, then we're essentially looking at, no more than a couple of months. Obviously, a lot can happen in a couple of months. So, who am I to say it can't? But it's been a really interesting cycle because we haven't really had any major parabolic rallies for Bitcoin. We obviously had some nice rallies, but we haven't had any rallies that, really got the euphoria moving, right? And, that's kind of something that has been different this cycle than in prior cycles. And you can actually see that if you go look at one of those indicators we've looked at before, the social interest, right? The social interest for crypto remains relatively low. So, and this entire move over here has just been sort of a more steady move, right? You move up, you establish a floor. You move up, you establish a floor. It's kind of just been like that all over and over and over again. Whereas in the 2020 cycle and the 2017 cycle, it was much more of a parabolic rally that really got people talking. And so because of that, we haven't really seen retail come back in the way that a lot of people thought they might. But again, this is all in line with that quantitative tightening approach we said back in 2019, that comparison back to 2019. Retail didn't come back then either.
These are not signs of collapse. They're signs of a maturing ecosystem where fundamentals are now leading price action. Lee expects Bitcoin and the broader crypto market to rally into year-end, driven by improved liquidity, declining inflation, and growing investor appetite for alternative assets. He echoes what other analysts like Benjamin Cowan have observed. This cycle is defined by fair value stability rather than euphoric overvaluation. In other words, crypto may not be exploding upward, but it's quietly building a sustainable base for the next bull phase.